The sell-off that we've seen in growth stocks recently comes without the Fed raising interest rates. In fact, they're still at the lower bound. Now, why is that? And why are they keeping their monetary policy in place right now when there are fairly clear signs that the economy is improving? Now, when they do actually increase interest rates, that's probably going to accelerate this growth sell-off and possibly move more towards a value style of investing. So it's really important to understand what will make them move their policy, but also roughly what kind of indicators to look at in order to guess what their policy will be. Now you'll notice that behind me here on the wall is a poster of Jack Bogle as a young man. Why is that there? Well, people were complaining about a mark on the wall, and week to week I'm going to let you vote on who goes on the wall. So you can do that by following us on Twitter. We'll have a poll every week at PensionCraft. So now let's look at what the Fed's doing in a bit more detail. Let's start off by looking at what the Fed's doing right now. This is a graph of the US central bank's policy rate called the federal funds target rate. It actually operates in a band, and you can see beneath me here, for the decade after the global financial crisis, most of the time that policy rate was in a band between 0 and 0.25%, which is its lower bound. Now, towards the end of 2019, they reached all the way up to about 2.5% on that policy rate. And equities were just fine. There wasn't a big sell-off in equity as a result of that increasing interest rate. But then towards the end of 2019, we had a slight problem with the plumbing of the bond market. It's something called the repo market. And then we had the pandemic hit in March 2020. And then, of course, the interest rate was pushed back down to 0, back to its lower bound. And as I make this video in March 2021, the Fed said it's going to keep interest rates at 0 for the time being. But interest rates are only half of their monetary policy. The other half is their asset purchase program or quantitative easing. Now, this means that they're buying US Treasuries at the rate of $80 billion worth every month. And they're also buying US mortgage-backed securities, which is a form of debt in the United States where they take home loans and then they package them up inside a bond. So the combined asset purchases every month are $120 billion. So there's absolutely no sign that the Fed is tapering. In other words, reducing the rate of asset purchases or even thinking about increasing interest rates. Now, if we look at the yield on US government bonds, and here I've got the 2-year yield in blue, I've got the 10-year yield in green, and I've got the 30-year yield in red. And this graph goes all the way back to 1980 and brings us to the present day. And what's pretty clear is that we've had 4 decades of falling interest rates. But what we're going to do now is zoom in on this part of the graph, which is most recent. Now, the colours in this zoomed in region of the graph are exactly the same, and this illustrates really nicely the effect of the policy rate on the yield curve. The federal funds rate most directly affects the short end of the curve. So that's US Treasuries, which have a short time to maturity. For example, this 2-year curve in blue. And you can see while interest rates have been at 0, that's pretty much pinned the 2-year close to 0 itself. But what you can see further out along the yield curve is that the 10-year and the 30-year have been steadily increasing since summer in 2020. Why is that? Well, that's because those parts of the curve, the longer end of the curve, prices in US growth expectations and US inflation expectations, both of which have been rising steadily as the US recovers from the pandemic. So even though the Fed has still got the short end of the curve pinned at 0, we've seen this steady rise in longer term interest rates, and that's what spooked markets and triggered this rotation away from growth stocks towards value stocks. So in the rest of this video, we're going to be looking at why the Fed is still remaining accommodative, still keeping rates at 0, and what's likely to make it change its mind and start to raise interest rates. Because rates will start to increase even faster, probably, once that starts to happen. To understand why the Fed's not raising interest rates now, you have to understand exactly what the Fed's goals are. The Federal Reserve has a dual mandate, and the first of those is maximum employment. That doesn't mean that everybody who can work is working. It actually means the Fed moves unemployment down to something which it estimates, which is called the natural rate of unemployment. So that natural rate of unemployment is this red line here, and you can see that after the pandemic hit, unemployment spiked massively, and it's still quite some way from the natural rate of unemployment. And the second part of the Fed's dual mandate is price stability. In other words, ensuring that inflation doesn't get too high or too low. And the Fed's target for price stability is inflation at a rate of 2%, which I've shown here with that dashed red line. Now, they've recently changed the way they're going to manage inflation slightly, and their point is that because inflation's been below their 2% target for some time, they're going to let it run a little bit hot, or in other words, moderately above that 2% target for some period of time. And if we look at a market implied rate of inflation, and this is based on a 5-year forward rate of inflation looking out 5 years from that point in time, that's only just at the Fed's 2% target. So it's not the case that inflation expectations are going crazy. Instead, markets are just expecting the Fed's going to hit its target over the medium to long term. But what's clear is that both parts of the Fed's mandate are not at its target, neither unemployment nor inflation. And Powell pointed out that there's clear scarring in the employment market in the United States. There are still 9.5 million Americans who had a job in February 2020, but who no longer have a job. And he also pointed out that the unemployment rate is still high at 6.2%, but that actually understates the shortfall. And the reason for that is the participation rate, which is the number of people actively looking for work, is below levels that it was at before the crisis hit. So you can see that both for men, which is the blue line here, the participation rate has fallen, and it's fallen even more significantly for women. So this is why the Fed is still not raising interest rates. The economy is still a long way from the Fed's employment and inflation goals, and the Fed thinks it's going to take some time for substantial progress to be achieved, even with monetary policy at full tilt as it is now. So what are the side effects of the Federal Reserve's monetary policy? The way I think of interest rates is a little bit like tides on a beach. When the tide goes out, usually you get all kinds of detritus left on the beach, as you can see here beneath me. These are the kind of assets which only perform well in an environment where interest rates are close to zero. But interest rates don't always stay at zero. They start rising again as they're doing now, and the reason for that is that growth is normalizing. And if we also see the Federal Reserve normalize its monetary policy by raising interest rates and stopping its asset purchases, then suddenly the environment's looking really hostile for all that junk that was on the beach during the zero interest rate days. So this illustrates the kind of asset which does very well when we have zero interest rates. This is called a zero coupon bond. So this initial cash flow that you can see here is going downwards because we've paid to buy the asset. But then while we hold the asset, the critical thing is that we receive no cash flows. There's really no monetary benefit of holding the asset at all. That is until we sell the asset. And then we receive a cash flow in, which is what people are willing to pay for that asset at that point in time. So the only way you can make money with this asset is via capital gain. Somebody else pays you more than you paid for it. Now, the classic example of a zero coupon bond type of asset would be something like gold. Gold doesn't pay you an income, and when it comes time to sell it, you're just hoping the price will be higher than the price you paid for it. But people are very creative, and in this zero interest rate environment, we've had a proliferation of different types of asset which are like zero coupon bonds. The most recent innovation which falls into this category would be something like a non-fungible token. So this painting from Beeple sold for millions of dollars, and if we compare the sale price with other artists, it's up there along with Francis Bacon and Botticelli. So if you buy this as an investment, you're just hoping that somebody else will pay you more than you paid for it, which in this case is, I think, fairly unlikely, but I don't know anything about art. Now, if you're into American football, you'll know about somebody called Gronk, and he's got his own very lucrative sideline selling NFTs. He sold his NFTs for $1.75 million. That's more than the 2020 salary of half of his Tampa Bay teammates. So certainly at the moment, people are willing to pay for this kind of zero coupon bond. But the question is, when it comes time to sell, will they be willing to pay as much as you've paid for it? And just like gold, many cryptocurrencies do not pay an income, which means they are another form of zero coupon bond asset. And of course, they've done very well during this period of zero interest rates. Another type of asset that might do very well when interest rates are very low is a growth stock. What do we mean by growth stock? Well, now you do get paid an income for holding the asset. And these cash flows would be the profits which are generated by a company. So this would be a company like Apple or another one of the large cap growth stocks such as Microsoft, or it might be a company like Tesla, which is very innovative and which potentially has very large cash flows in the future. Now, when it comes time to value these cash flows in terms of what they're worth today, when interest rates are very low, those future cash flows are worth much more. But as interest rates rise, the value of those future cash flows diminishes. And that means that growth stocks are very sensitive to interest rates. And of course, the poster child for growth stocks is Cathie Wood's ARK funds, which just did incredibly well in 2020 and at the beginning of 2021. But then as interest rates gradually increased, what was pretty clear was that these became less attractive. So the ARK K fund seemed to turn around very rapidly, and it's been selling off pretty much ever since. And that turnaround point happened when the 10-year Treasury yield increased above 1.25%. And if we look at the stock prices of the equities which are held by that fund, you can see that they've all fallen since February the 12th up to when I make this video on March the 18th. Only one of them has actually increased in price very slightly over that period of time, whereas all of these other stocks have had substantial losses. So as interest rates increase, growth stocks are the ones which suffer the most. But it's not true that all stocks will do badly. So if we have a stock like this, where the cash flows are not increasing at an incredible pace, those kind of stocks have been unpopular while growth has outperformed, and consequently their prices have suffered. But now those stocks are actually becoming more popular. So in this bottom panel here, this is the 10-year Treasury yield. And these graphs both go back to 2005. And in this upper panel, what I've shown is the outperformance of value versus growth. So value stocks would be those unloved stocks where the growth isn't too much. And here I've simply used two US Vanguard ETFs and subtracted the growth ETF return from the daily value ETF return. So when this line is increasing, as it did just before the global financial crisis in this 2-year run-up period, that means that value is outperforming growth. But after the global financial crisis, as interest rates fell to zero thanks to Fed policy, you can see that value consistently underperformed for that decade-long period. And most recently, in this period since the beginning of 2020, the underperformance of value actually accelerated as the Fed cut interest rates to zero again. But if you look at this little blip recently, you can see that value has started outperforming growth. Now, some people think that the Fed will step in to stop the bond sell-off. So here's a question from Steve Leisman, who's from CNBC, and he's asking about the current level of the 10-year yield for US Treasuries, but also some other long rates out there, and he's asking whether those higher interest rates are going to have a negative effect on the economy, which is a roundabout way of asking, is the Fed about to step in and buy more of those 10-year and longer duration Treasuries? And Powell's response, which is completely consistent with what he said before, is that he's only concerned about disorderly conditions in markets. In other words, a market where you can't buy or sell treasuries, where liquidity is reduced. And that's certainly not the case at the moment. Liquidity still abounds in the treasury market. Another thing that would worry the Fed would be a persistent tightening of financial conditions. And what that means is that credit spreads would widen, or that companies wouldn't have access to credit in order to grow. But that's still not the case. Credit spreads are still very tight and interest rates are still very low. So there is just no reason for the Fed to step in just because yields are gradually increasing. Or to simplify and translate that Fed speak, the answer is no. The Fed is not going to step in if yields simply increase. And if you look in detail at the transcript and what Powell says about the economy, he certainly seems to be more optimistic about the near future. So for example, he says, I don't worry too much about us in the near term, us being America, because we're on a very good track. Very strong fiscal support coming. And here, of course, he's talking about Biden's $1.9 trillion stimulus program. But if you look at the combined stimulus that we've had so far in the US, compared to the Euro area and compared to Japan, as a percentage of GDP in those countries, the US is really the only show in town. And that's very likely to help the Fed achieve its dual mandate of having inflation moderately above 2% for some period of time and to get closer to full employment. Powell also pointed to the vaccination program now going very quickly. So if you look at the number of people who have been vaccinated in the US, we're now well above 100 million vaccinations, and the actual rate of vaccination is increasing. And we've also seen US cases and cases elsewhere coming down. So he says, I think we're in a good place. It's all ahead of us, the good news. But the data should get stronger fairly quickly here and remain strong for some time. Now, from November to January, it looked as if the recovery was almost coming to a halt in terms of jobs. But the most recent employment data that was published this month was much more positive, with employment rising by 379,000, and the leisure and hospitality sector, which was very hard hit, remember, has recouped about 2/3 of the jobs lost in December and January. So it's great to see that very hard hit sector finally start to recover. So we should be thinking about what's going to happen when the data improves. And as always, the Fed says that they are data dependent. Once the economy starts to improve, their outcome-based guidance, they just listen to the data, will immediately adapt to meet whatever the actual path of the economy is. And if, as we've seen, that data continues to improve, then of course the Fed will cut back on its asset purchases and it'll start to think about raising interest rates. It will taper. So I don't think it's a case that this underperformance of growth versus value is going to go away anytime soon. We are starting to see the data improve, but of course the Fed is still going full tilt. Once the Fed starts to actually cut back on its asset purchases, I think we could actually see an acceleration of the underperformance of growth versus value. So don't expect the Fed to step in just because interest rates are increasing. That's not going to happen. Now, a wonderful way to learn more about investing and things like value and growth and when they outperform is as part of our Patreon community. It's very easy to join. You simply click on the link in the description below me or next to me to find out more. And if you do that, you'll have access to Slack, so you can talk to me or other members of the community anytime you like. And you get access to an increasing library of members-only content, which is actually decided by the members themselves. They vote, or you would vote, on what questions we answer. And, as always, thank you for listening.